Hello viewers, I Neela welcome you to the episode on cost analysis. In this episode, we'll study the analysis of the forces determining supply of goods. We shall examine how here the cost of production of a firm changes with a change in its output. We'll learn the concept of accounting and economic cost and define opportunity cost. We're going to discuss also the total fixed variable cost, average fixed, average variable, average total and marginal cost. Also, we will define the relationship between the average cost and the marginal cost. We shall see how much cost a firm will incur on production depends on the level of output. But we will first acquaint ourselves with the terms which are going to be used in the discussion. Cost analysis refers to the study of behavior of cost in relation to one or more production criteria, namely size of output, scale of operations, prices of factors of production, and other relevant economic variables. In other words, cost analysis is concerned with financial aspects of production relations as against physical aspects which were considered in production analysis. In order to have a clear understanding of the cost function, it is important to understand various concepts of cost. In this chapter, we carry further the analysis of the force determining supply of goods. We shall examine here how the cost of production of a firm changes with the change in its output. The relationship between cost and output is called the cost function. The cost function of the firms depends upon the production conditions and the prices of the factors used for production. How much cost a firm will incur on production depends on the level of the output. Proper understanding of the price theory is necessary to know the different concepts of the cost that are often implied. When an entrepreneur undertakes production of a commodity, he has to pay prices for the factors which he employs for production. He thus pays wages to the laborers employed, prices for the raw material, fuel and power used, rent for building he hires for the production work, and the rate of interest on money borrowed for doing business. All these are included in his cost of production. An accountant will take into account only the payments and charges made by the entrepreneur to the suppliers of different productive factors. The accounting costs are contractual cash payments which the firm makes to other factor owners for purchasing or hiring the various factors are also known as explicit cost. The normal return money capital investment by the entrepreneur and the wages or the salary for his services and the money reward for other factors which the entrepreneur himself owns and employs them in his own firm are known as implicit cost or imputed cost. The economists take into consideration both explicit and implicit costs. Therefore, the economic costs are equal to the sum of accounting cost and implicit cost. The concept of economic cost is important because an entrepreneur must cover his economic cost if he wants to earn normal profits, and abnormal profits are over and above these normal profits. In other words, an entrepreneur is set to earning profits abnormal only when his revenues are able to cover not only his explicit cost but also implicit cost. Opportunity cost occupies a significant place in modern economic analysis. The opportunity cost of any good is the value of next best alternative good that is sacrificed. The factors which are used for the manufacture of a car may also be used for the production of equipment for the army. Hence, the opportunity cost of production of a car is the output of the army equipment forgone or sacrificed, which could have been produced with the same amount of factors that have gone into the making of a car. The alternative or opportunity cost of a good can be given a money value. In order to produce a good, the producer has to employ various factors of production and have to pay them sufficient prices to get their services. These factors have alternative uses. The factors must be paid at least the price they are able to obtain in the next best alternative uses. The total alternative earnings of the various factors employed in the production of a good will constitute the opportunity cost of the good. There are some inputs or factors which can be readily adjusted with the changes in the output level. This labor, raw material, chemical, etc. are the factors which can be readily varied with the change in the output. Such factors are called variable factors. In spite of there are factors such as capital, equipment, building, top management personnel which cannot be so readily varied. It requires a comparatively long time to make variations in them. It takes time to expand a factory building or to build a new factory building with a large area or capacity. Likewise, it also takes time to order and install new machinery. The factors such as raw material, labor, etc., which can be readily varied with a change in the output level, are known as variable factors, and the factors such as capital, equipment, building, which cannot be readily varied and require comparatively a long time to make adjustment in them, are called fixed factors. The short run is a period of time in which output can be increased or decreased by changing only the amount of variable factors such as labor, raw material, chemicals, etc. In it, quantities of the fixed factors such as capital, equipment, factory, building, etc. cannot be varied for making changes in output. While the long run is defined as a period of time in which the quantities of all factors may be varied. All factors being variable in it, the fixed and the variable factors dichotomy holds good only in the short run. In long run, the output can be increased not only by using more quantities of labor and raw material, but also by expanding the size of the existing plant or by building a new plant with a larger productive capacity. It may be noted that the word plant in the economics stands for a collection of fixed factors such as factory building, machinery installed, the organization represented by the managers, and the other essential skilled personnel. Fixed costs are those which are independent of output, that is, they do not change with the changes in output. It is also known as overhead cost and include charges such as contractual, rent, insurance, fee, property, taxes, minimum administrative expenses such as manager's salary, watchman's wages, etc. Thus, fixed costs are those which are incurred in hiring the fixed factors of production whose amount cannot be altered in the short run. Variable costs, on the other hand, are those costs which are incurred on the employment of variable factors of production whose amount can be altered in short run. Thus, the total variable cost changes with the changes in the output in the short run. That is, they increase or decrease when the output rises or falls. Variable costs are made only when some amount is produced, and the total variable cost increase with the increase in the level of production. Variable costs are also called prime cost or direct cost. A total cost of a business is the sum of its total variable cost and total fixed cost. Thus, total cost TC is equal to total fixed cost TFC plus total variable cost TVC. where Q is the number of units of output, TFC is total fixed cost, TVC is total variable cost, and TC is the total cost. Now, image 1.1 gives the total fixed cost, total variable cost, and total cost. It is the cost concept more frequently used by the businessmen and economists in the form of cost per unit or average cost rather than as total average fixed cost AFC. It is the total fixed cost divided by the number of units of output produced. Therefore, AFC is equal to TFC divided by Q, where Q represents the number of output produced. This average fixed cost is a fixed cost per unit of output. The average variable cost AVC, it is the total variable cost divided by the number of units of output produced. Therefore, AVC is equal to TVC divided by Q, where Q represents the total output produced. This average variable cost is variable cost per unit of output. The average variable cost will generally fall as output increases from 0 to the normal capacity output due to the cost occurrence of increasing returns. But beyond the normal capacity, output average variable cost will rise steeply because of the operation of diminishing returns. Now, let's see what is average total cost ATC. The average total cost, or simply called the average cost, is the total cost divided by the number of units of output produced. So, average total cost ATC is equal to total cost divided by output, that is TC by Q. Since the total cost is a sum of total variable cost and total fixed cost, the average total cost is also the sum of average variable cost and average fixed cost. This can be proved as follows. ATC is equal to TC by Q. Since TC is equal to TVC plus TFC, therefore, ATC is equal to TVC plus TFC by Q. So, that is equal to TVC by Q plus TFC by Q, which is equal to AVC plus AFC. Average total cost is also known as unit cost, since it is cost per unit of the output produced. As the average total cost is a sum of average variable cost and average fixed cost. Now, marginal cost, that is MC, marginal cost plays a vital role in the economic theory. It is addition to the total cost caused by the producing one more unit of output. This marginal cost is the addition to the total cost of producing n units instead of n minus 1 units, that is 1 less, where n is any given number. In symbol, MC is equal to TCN minus TCN minus 1. Suppose the production of 5 units of a product involves a total cost of rupees 206. If the increase in the production to 6 units raises the total cost to rupees 236, then marginal cost of the 6th unit of output is rupees 30, which is obtained by subtracting 236 minus 206 will give us 30. Let us illustrate the computation of marginal cost from a table of total cost and output. In the following table, when output is 0 in the short run, the producer is incurring total cost of rupees 100, which represents the total fixed cost of production. When 1 unit of output is produced, the total fixed cost rises to rupees 125. The marginal cost of the first unit of output is therefore rupees 25, which is 125 minus 100, which is equal to 25. When output is increased to 2 units, the total cost goes up to rupees 145. Therefore, the marginal cost is now rupees 20, which is obtained by subtracting 145 minus 125. In this way, marginal cost can be found for further units of output. Now, marginal cost MC is equal to delta TC by delta Q, where delta TC represents a change in total cost and delta Q represents a unit change in output or total product. If we consider the total cost curve, delta TC by delta Q represents the slope of it. Therefore, if you want to measure the marginal cost curve corresponding to that output, draw a tangent to it. It is worth pointing out that marginal cost is independent of the fixed cost. Since fixed costs do not change with the output, there are no marginal fixed costs when output is increased in the short run. It is only the variable costs that vary with output in the short run. Therefore, the marginal costs are in fact due to the changes in the variable cost, and whatever the amount of fixed cost, the marginal cost is unaffected by it. The image 1.2, it gives the short run average cost and marginal cost curves. The relationship between marginal cost and average cost is same as that between any other marginal average quantities. The following are the points of relationship between the two phenomena. First, when average cost falls as a result of an increase in output, marginal cost is less than average cost. Second, when average cost rises as a result of an increase in output, marginal cost is more than average cost. Third, when average cost is minimum, marginal cost is equal to the average cost. In other words, marginal cost curve cuts average cost curve at its minimum point, that is optimum point. The long run is a period of time during which the firm can vary its input. In the short run, some inputs are fixed and others are varied to increase the level of output. In the long run, none of the factor is fixed and all can be varied to expand output. The long run production function has therefore no fixed factors and the firm has no fixed cost in the long run. It is conventional to regard the size or scale of plant as a typical fixed input. The term plant is here to be understood as consisting of capital, equipment, machinery, land, etc. In the short run, the size of the plant is fixed and it cannot be increased or reduced. That is to say, one cannot change the amount of capital equipment in the short run if one has to increase or decrease output. On the other hand, long run is a period of time sufficiently long to permit the changes in plant, that is, in capital, equipment, machinery, land, etc. in order to expand or contract output. Thus, whereas in the short run, the firm is tied with a given plant, in the long run, the firm moves from one plant to another. The firm can make a larger plant if it has to increase its output and a smaller plant if it has to decrease its output. The long run average cost of production is the least possible average cost of production of producing any given level of output when all inputs are variable, including of course the size of the plant. A long run cost curve depicts the functional relationship between output and the long run cost of production as just defined. Long run average cost is the long run total cost divided by the level of output. So, long run average cost curve depicts the least possible average cost for producing all possible levels of output. In order to understand how the long run average cost curve is derived, consider the three short run average cost curve as shown in figure 1.3. These short run average cost curves are also called plant curves, since in the short run plant is fixed and each of the short run average cost curves corresponds to a particular plant. In the short run, the firm can be operating on any short run average cost curve given the size of the plant. Suppose that only these three are technically possible sizes of plant and that no other size of the plant can be built. Given a size of the plant or a short run average cost curve, the firm will increase or decrease its output by varying the amount of the variable inputs. But in the long run, the firm can choose among the three possible sizes of plant as depicted by short run average cost curves SAC1, SAC2 and SAC3. In the long run, the firm will decide about with which size of plant or on which short-run average cost curve it should operate to produce a given level of output at the minimum possible cost. It will be seen from image 1.3 that up to OB amount of output, the firm will operate on the short-run average cost curve SAC1, though it could also produce it with short-run average cost curve SAC2, because up to OB amount of output, production on SAC1 curve entails lower cost than on SAC2. For example, if the level of output OA is produced with SAC1, it will cost AL per unit, and if it is produced with SAC2, it will cost AG per unit. It will be seen from the image 1.3 that AL is smaller than AH. Similarly, all other output levels up to OB can be produced more economically with the smaller plant SAC1 than with the larger plant SAC2. It is thus clear that in the long run, the firm will produce any output up to OB on SAC1. If the firm plans to produce an output which is larger than OB but less than OD, then it will not be economical to produce on SAC1. It will be seen from image 1.3 that the output larger than OB but less than OD can be produced at a lower cost per unit on SAC2 than on SAC1. Thus, the output OC, if produced on SAC2, cost CK per unit, which is lower than CJ, which is the cost incurred when produced on SAC1. Therefore, if the firm plans to produce between output OB and OD, LB employ the plan corresponding to short-run average cost curve SAC2. If the firm has to produce an output which exceeds OD, then the cost per unit will be lower on SAC3 than SAC2. Therefore, for output larger than OD, the firm will employ plant corresponding to the short-run average cost curve SAC3. Long-run average cost curve is often called the planning curve of the firm by some economists, because a firm plans to produce any output in a long run by choosing a plant on the long-run average cost curve corresponding to the given output. The long-run average cost curve reveals to the firm that how large should be the plan for producing a certain output at the least possible cost. Thus, while making decision regarding the choice of a plan, the firm has to look at its long-run average cost curve enveloping a family of plant or short-run average cost curves. It is important to explain the concept of optimum firm. The optimum firm refers to the best or ideal size of the firm. More specifically, optimum or best firm is considered as one that has set up a plant with lowest possible cost and is also operating it at its lowest average cost point. E.A.G. Robinson, who has done a good deal of research on the issue of optimum firm, writes, "An optimum firm is the one which operates at the scale at which, in the existing conditions of technique and organizing ability, has the lowest average cost of production when all those costs which must be covered in the long run are included." This means that optimum firm is one which operates at the lowest point of the long run average cost curve of production. Production at the minimum point of the long run average cost curve is called optimum because at it resources of the society are most efficiently used. When a firm expands its size to the lowest unit cost of production when operated at its full capacity. As the firm expands its scale of production, certain economies and diseconomies accrue to it, which are called internal economies and diseconomies. So finally, let's quickly summarize what we have learned in today's session. We have learned today the chapter of cost analysis. In this episode, we have studied the analysis of the force determining supply of goods. We examined here how the cost of production of a firm changes with the change in its output. We have learned the concept of accounting and economic cost and defined opportunity cost. We have also discussed the total fixed, variable cost, average fixed, average variable, average total and marginal cost. Also, we have defined the relationship between the average cost and marginal cost. We have seen as well how much cost a firm will incur on production depend on the level of output. So that gets us towards the end of today's episode. We're ending here the chapter of cost analysis, and we'll see you again discussing about our next topic on break-even point analysis. Till then, have a nice time. Thank you and bye.